Welcome back to Real Estate Mindset. This video is going to be extra bonkers. This is going to be a live video. I'm going to switch up the value part of this video, you guys. I have a viewer on our comment section right now, Julius, who actually is interested in purchasing a home. So what I'm going to do live on this video is a market analysis on the area that he's interested in. So that's what I'll be changing. I was going to do today's value doing property archive reviews, which is really good tool as well to have, but we're going to stick to the market analysis because he is actively looking at houses, and that takes precedence over what I wanted to do because I want to give back to my viewers. So brother, I appreciate you reaching out. We'll do that towards the end of this video. But you guys, happy Thursday. One more day till Friday. I hope each and every one of you that's watching these videos is becoming a better, more aware home buyer. That's the point of these videos, to empower you guys so that you are well prepared, right? And also, you guys, don't forget, this is your sole decision to buy, no one else's decision but your own. And if you are on the sideline, even if you're not on the sideline, you should always be improving your purchasing power by improving your credit, your income, and your assets. So don't forget that, you guys. We're going to jump into this right away. Let me say good morning real quick. Really excited about that market analysis because that's something we're going to do live for, giving back to someone that's viewing. But good morning, Mary. Look at Jeff. Jeff is the second one here. Jeff, good morning to you, sir. I absolutely love you. And here's Julius. This is the man that we're going to do the market analysis for right here. Good morning, Dean and Ben. Appreciate you guys very much. Let me see here. And then we had a long conversation. Don't move. Appreciate you, Christy. I hope you guys are joining the morning lives. These are so fun. Don't move. There you are, brother. Medic is in the house. So I appreciate. There's Johnny. I was going to say, where's Johnny? There's my girl, Melissa. Melissa, how are you? I hope everything is well, girl. I hope you're staying motivated and empowering yourself. Do not give up on your dreams. Ever stay motivated, Melissa. Good morning to you, Steve. Nice to see you. Medic, nice to see you. We're going to get started, you guys, right now. Sorry if I didn't make it to, I'm going to say a little bit. Good morning. Good morning. Good morning. Good morning. Good morning. And my Wolf. Good morning, Wolf. Love you, man. Hope everything's getting better out in Phoenix. It probably will. So we're going to get started right now, you guys, with our market update. And then we're going to get into a few videos that I think you're going to like, these videos that we're going to go into today. At least I hope you do. But let's start with the 10-year treasury, okay? Now, obviously, the title of this video is Mortgage Rates Flipped. And you're not going to see that right here with today's numbers, but yesterday, you guys, and of course, I didn't do a live yesterday. So the day I don't do a live, huge fluctuation in the 10-year, you guys can see it was just at 4.3. It was in the 4.3s. It's now sitting at 4.2. So if you've been following along, you're probably asking, what just happened, right? So in other words, you guys, yesterday, the 10-year treasury went down a whopping 13, I think it was about 13 to 14 basis points is where it ended yesterday. So there was a substantial drop in the 10-year treasury that will be impacting residential mortgage rates. So let's see, with that huge drop, what did that bring mortgage rates down to? Let's see right here, okay? So mortgage rates went all the way down to 7.36%, okay? So even with that massive drop in the 10-year, you guys, the interest rates are still sitting well above 7%, which is probably exactly what we need. We can't have interest rates right now in the 6%. When we have interest rates in the 6%, buying activity blows up, unfortunately. Now, I also want to tell you guys, I read a report that was published about 6 days ago that is saying that excess savings is going to run out by October. By October, you guys, of this year. So excess savings running out October of this year. Are you kidding me? We were supposed to go into next year. So all of that excess savings, you guys, is about to be burnt. A lot of people are expecting it to end in October. And guess what else happens in October? School loans start. There is so much economic headwinds that are affecting the economy and the housing market right now. It's really hard to pay attention to all of it. So let me jump in now, you guys, and show you. This is crazy. Let me show you the overnight reverse repo facility. Now, this is where banks store your money, right? Your deposits or money market accounts. And the crazy thing here is this is going up again. So it's still going up, you guys. The trend is going up. It was plateauing, obviously going down greatly because a lot of that money was going into the treasuries, obviously. But you guys, I'm actually surprised that this is going up, being that the yields have been going up. So they're actually higher, and yet the money is staying parked here. That's surprising to me, again, because it's been more profitable to invest in treasuries. So again, what I'm anticipating, you guys, is this, what we're looking at right here, is going to be another reason. There's going to be many reasons, I believe, but this will be one catalyst on why those interest rates are going to go higher. Basically, they're going to pull the money out of here and they're going to burn it, so long as they're still doing quantitative tightening. Let me show you guys the M2. The M2 is absolutely crazy. This set of data right here, I mean, I don't think that we can really overstate how crazy it is that M2 money supply goes down, right? The last time M2 really went down, like significantly went down, was the Great Depression, right? Well, basically the Great Depression when we topped quantitative tightening. So M2 is going down. A lot of people say that this tracks the S&P, right? So look at this little rebound right here. And what I really want to point out to you guys is since about April, M2 has actually been going up. Okay, now this just updated 2 days ago. That's why I'm referencing it again. So this updated 2 days ago. And month over month, it went up only slightly. Okay, so it is plateauing what we want to see, you guys. And honestly, we're probably going to see this. We're probably going to see it start going down again, especially now that we're almost done with home buying season. The fact that we're finally almost done with that, I think this is going to go down. Maybe I'm wrong. Definitely keep your eye on the M2 money supply. It did go up again ever so slightly, but take a look at this. Here's the quantitative tightening. Okay, this is quantitative tightening right here. This is the Fed balance sheet. Okay, and I wanted to point out, again, this updated about 1 week ago. It updates weekly on Wednesdays. Not sure why it didn't update yesterday. That's very surprising. So it's still going down. And look at the trajectory. Week over week trajectory. And this is basically the Fed burning money, right? They're burning money. They're getting rid of money. They're trying to combat inflation. So they're getting rid of money. And we can see that right here. And again, you guys remember this huge run up right here, this brick wall, if you will, was the bank bailout. This was the bank bailout in March right here. Okay. They don't call it a bank bailout. Maybe we shouldn't call it a bank bailout. But as of right now, until I get more information and we know what happens next, it was a bank bailout. And it put a huge damper on the economy and housing market reset. I mean, when you inject $400 billion into the financing sector, it's going to spread to the rest of the economy. We know that, especially in the financing sector, because in the financing sector, banks lend money to other people. But look, guys, again, trajectory is going down. So that is good news, but we want to see this go down and we want to see the M2 money supply go down. So next, we are going to take a listen to a video that's basically going to go into what is happening this Friday. A lot of the market is anticipating Jerome Powell's speech tomorrow. Now, I'm going to try to do the speech live. Now, what I suspect is going to happen with his speech is he's probably going to try, listen to me very carefully. I think Jerome Powell, when he talks tomorrow, he's going to try not to crash the market. I think he's going to try to come off, this is what I hope anyways, I think he's going to try to come off dovish, but because the reality of what's happening right now, I still think he's going to say 2% target. He's going to say higher for longer. I think it's going to crash. I think the market's going to go down as a result because, again, it's the reality. So I think he's going to try to downplay what is happening so he can continue it. But again, it's in their face, right? Things are in their face. The labor market, GDP, I mean, everything is kind of falling apart. It's being propped up by BS information, BS statistics, obviously, guys. But the first video we're going to go into is basically on what people are expecting from Jerome Powell on Friday, which is tomorrow. It's only a 2-minute video.
Michael, I want to go to that moment that we'll all see where
The
Powell,
audio okay?
Ueda, newly minted at Japan, Broadbent in for Bailey, and of course Lagarde speaking as well. They're going to wander out and point to the scenery behind you. What are they going to be thinking about? What is the common ground of 4 central bankers as the Kansas City Fed meets to greet?
Well, I think there's 2 things, Tom. The first is they're going to look at these mountains behind me and they're going to say, wow, it's real. It is so beautiful. And then they're going to think about what are we going to do to keep inflation down in the 3 countries that have inflation problems, and what are we going to do to keep inflation up in Japan? Those are their main goals going forward. And while all of that does seem to be happening as the central bankers would like it to, they can't really explain all the reasons why. And so this conference may be able to provide some grounding for the central banks as they try to figure out what their moves in the coming years are going to be.
I looked, Mike McKee, at the niceties of this in the Kansas City Fed for our international audience as well. Can you explain the transfer of power at Kansas City? You and I were with Esther George last year in the grill with a baby puppy pivot, and now we have Schmid of Kansas City. Tell me about Schmid of Kansas City.
Well, he started, as the tradition at the Kansas City Fed seems to be, as a bank examiner, not at the Fed, but at the FDIC, but worked his way up in banking, ran a couple of banks, did a stint as CEO of Mutual of Omaha. So we will get Marlon Perkins out here to find us a moose. And then ended up running a family bank in Dallas. So he's got a banking background, same as Esther George and same as her predecessor, Tom Honig. So the bank stays consistent in that. As for his monetary policy, we have no idea at this point. He's only just started on Monday.
Michael.
Oh my gosh. All right, guys. So that is first video. Oh my gosh, the audio is still playing. Why is that? So, not too much there, but, it is important. There's a lot of people, that are waiting for that information, obviously. And what about that background? And what about that getup that he had? I mean, I live in Texas. I still can't rock that cowboy outfit. I just don't have the confidence. I mean, he rocked it, though, I'll be honest. So let's go in now, guys, and see if the CME Fed Watch has updated and changed. Okay, so this is the tool that we use to kind of get an idea on what's going to happen next with the interest rates, so we don't have to be completely blinded. Here, let me throw this up. I'm not sure, brother. Remind me what your email said. Put in the subject line from I'm not going to even pronounce your name, brother, because I am with the slow reading group. Hooked on Phonics did not work for me. I was one of the 8 children in America that got refunded from Hooked on Phonics. I'm just kidding. I'm just horrible at it. But email me and put your name in the title, because I should have responded to you. But my email is in my description, you guys. So if you want to reach out, if you have any questions about real estate, specifically commercial. I'm starting to get in more to commercial, not residential, for obvious reasons, right? But here's the CME Fed Watch tool. Let's look at November. Oh, wow, got to 15. Look at this. This actually changed. So this is interesting. So this has gone up to 15%. Still not likely they're going to raise the rates a quarter basis point in September. Now, this all may change tomorrow. So depending on what Jerome Powell says, this may completely flip. Like, for example, if Jerome Powell says we're going to raise the rates a quarter point in September, the market's going to melt down. The reason is they're not pricing it in. Look, see, we can see they're not pricing in a rate increase in September. But when we go to November, it's actually under 40 now. That's interesting. So we're at 39.4% chance in November, you guys, of a 25 basis point rate hike. And in December, let's see. Same thing in December, about the same, 37.4. But more importantly, let's look at May. Okay, so this is where we're sitting in May. So as of May, basically, there's probably over a 50% probability, according to this, you guys, 50% probability, according to this, roughly, that rate cuts will start in May. I'm saying I hope we can last till right here, which is July. The only reason we don't last till July is if something big breaks. If something big breaks and that triggers recession, more than likely the Federal Reserve will cut rates. So we don't want them to start cutting rates right in front of home buying season like happened this year. They injected money in the economy and lowered interest rates in the front of home buying season, like literally right in the front of home buying season. So that was really bad. But you guys can see here when we look at July, and I hope we make it here. July is basically, in long story short, July is saying 90% likelihood of rate cuts. So by July, there's a 90% chance, according to the market, that we'll already be in a rate cut environment. Okay, so about 90% chance. So highly likelihood that by July, rates will start being cut, right? And I hope you guys see that here. So let's go here now. We're going to go into our next video. You guys know our next video is an interesting video, and I think you guys are going to like it. The next video is basically, going into the fact that the housing market is due for correction. So we're starting to see a lot less bullish narratives. We're seeing a lot more bearish and cautious narratives. And I want to point out the video that we're about to watch right now. I mean, maybe I'm just flattering myself here, you guys, but this guy keeps dropping the word bonkers. Okay, multiple bonkers in this video. He probably doesn't know who I am, but if he does, bro, where's the credit in the bonkers, man? Give me some credit in the bonkers. But anyways, guys, I hope you enjoy this video. It's another basically opinion on what's going to happen next with housing.
Guest now is Kobasi Letters editor-in-chief Adam Kobasi, doing some great work. I've ripped off some of your stuff for my RBI, Adam, so I appreciate you coming on the program.
Absolutely. Thanks for having me.
Sure. We know how bad the situation is. I guess the question I would ask you, and I know it's going to be a guesstimate, is how long does this state of real estate last? To me, that's the bigger question.
Right. And as you kind of alluded to, this all really trickles back to interest rates. You've had the Fed funds rate rise at one of the fastest paces in history, which has basically led to mortgage rates nearly tripling in a matter of 2 to 3 years. And now you have the situation where the only thing to buy is new construction. For the first time since 2005, the median sales price of a new home is actually about to drop below the median sales price of an existing home. And this is also like a big factor of markets kind of beginning to price in a prolonged higher for longer Fed policy. If you look at futures, we went from having 3 to 4 rate cuts priced in 2023 to having none at all. And now rate cuts as of today are actually not projected to start until June of 2024. So as long as the Fed's fund rate stays as high as it is, it's hard to see a situation for the housing market supply situation to alleviate, particularly as we're kind of in a weird situation now where, ironically, now we need lower rates for lower housing prices, which is something we haven't really ever seen before.
That's why I said bonkers. And what you just said earlier is just as equally bonkers.
Bonkers.
That it's very close where the price of a newly built home will be, the median price nationwide will be less than the median price of a, quote, used, previously lived in house.
Exactly.
That's nuts. Because home builders, they can manipulate things, right? They can maybe shrink the house a little bit, use cheaper materials. They've got the ability. If somebody during the pandemic bought a house with cheap or almost free money, prices soared, they're locked in. Unless they're like, a billionaire, they're not going to be able to sell and lose money on that home.
Exactly. And what you have to also take into account is with the prolonged period of low rates, historically low rates, a lot of these houses were actually bought by investors. So that took a lot more of the supply off the market. And now you see, that's exactly why new home housing starts are strong right now. There's really no other option. The new construction is what you're seeing on the market. Existing homes are not selling because people are, over 90% of current mortgages are below 5%, 26% are below 3%. And no one wants to give up those rates to take a rate that's now 7.5% or higher, in some states 8%, and sell their house. So it's really going to take the Fed to start cutting the Fed funds rate. And that probably doesn't happen until mid-24 before you see more supply come to the housing market. Even a little bit of demand is keeping housing prices up right now.
I said this in 2009 when everything collapsed. I wonder when some genius will be able to create a mobile mortgage, a mortgage you can take with you from one house to the next. Probably not. It's tied to the land, fee simple. I get it. That said, Adam, do you see this being a 2008 to 2010 or 11 like situation?
Absolutely not. I think we're in a very different situation. There have been increasing worries of some sort of a credit event, particularly as China's, starting to cut rates now, and there's different situations happening with central banks around the world. But this isn't an 08 type situation. I think what we will see is once the Fed starts cutting rates in 24, we'll see a slight correction in housing prices, maybe from 10 to 20%, maybe even 30%. And keep in mind, affordability.
Y'all, did y'all hear what he just said? Okay, he said 10 to 20, maybe even 30% price correction when they drop rates. Did y'all get that? He said when they drop rates, he expects a 10 to 30% price correction. Very interesting.
Has actually become, according to data, the affordability index is now at its all-time lowest point. Even if prices came down 30%, we'd still be in a less affordable point than pre-pandemic.
Yeah.
So I think we are due for a correction, but I don't think it's an 08 style crash that's coming.
All right, well, that's
all right, guys. So did you guys hear what he just said? So basically, you guys can see the narratives, you know, starting to swing here, but you know, he basically said, you know, even if home prices go down, even the prices of homes go down 30%, it's still more unaffordable than pre-pandemic. So you know, there's a huge unaffordability problem. But let me explain, you guys, because I think about this, right? You know, as we get more data, my opinion is enhanced. You know, my opinion evolves. I don't suspect that through this like bust cycle that we're going through, I don't suspect that it will be like 2008 in the sense of foreclosure. I don't think we're going to have nearly as much foreclosure this time around because there are many more people, homeowners, that are better prepared, right? Because again, you guys remember, I was a loan officer in 2002. I went through every stage of the great financial collapse. And back then, everyone was refinancing, but not into 2 and 3% interest rates. People back then were refinancing into 6 and 7% interest rates and cashing out everything they had. So I don't think that will have an unhinged foreclosure crisis because of that, and also because of the efficiency of loan modification. But one thing that I think that will be worse than 2008, specific to metro areas, right? So maybe not where Jeff lives, you know, where it's a tight market, but prices. I'm talking about price crashes. So we could still have price decline and not have an unhinged foreclosure crisis. And I think we'll see that, you guys. You know, again, time will tell. This is all on the front end of obviously unemployment, lack of recession. But let me show you guys a little bit of the updated data for new homes, because we have new home data that just came out. This came out yesterday. So here's the median home price, guys. I wanted to show you for new homes. So it went up slightly, about 20,000 from month over month. It's still down $60,000 from the peak. And I also wanted to point out that, you know, this increase was during the busiest time of year when they're offering the most aggressive buying incentives in history. Do y'all understand what I'm saying? So finally, they got a little bit of an uptick. That's, again, you guys, it's probably going to go straight down. Again, we're past the massive home buying, you know, delusion and obsession. But also look at this. Okay, this just updated as well. You guys can see here 901. What's going on? Please work. I'm live right now, Fred. Don't do me like this. All right. So here is these months of supply for new homes. So we're now sitting at 7. Look at the revisions. My God. So they revised last month upward. Interesting how, anyways. So they revised last month upward, you guys. Let me see if they revised the peak. So that's about the same. So we're sitting at 7.3 months. So that actually went up. We were sitting at 7.2 allegedly last month, even though that was revised. So again, you guys, plenty of options in new construction. But listen, so long as you live in a metro area that has a lot of it. If you guys go to San Diego, for example, San Diego don't have that much new construction. You guys go to Houston, where I live, you'll find new construction everywhere. So it is specific. That's what I'm trying to say. All right. So it is specific. We're going to go into something else now. Let me do my timestamp real quick, guys. We're going to go into our third video right now. And this video is this video that I'm about to show you right here, you guys. Okay, you know, people want to talk about the strength of home buyers right now, but let me show you this video, you guys. This video is crazy. Look at this. It's basically going to go into how 40% of first-time home buyers right now are getting the down payment from their parents. Raise your hand if your parents gave you a down payment. My hand's not being raised. Am I jealous? Maybe. Maybe not. I don't know. But take a listen to this, you guys. I hope you enjoy.
Is going on here. Joining us now for more is Zillow chief economist Skylar Olson. Skylar, it doesn't make sense. Help it make sense. With these rates, how can people with assumingly no money be half the market?
Absolutely. Well, when we think about it, right, we have to put that number into context. So yes, home buying activity in general is pulled back because of the affordability challenge. But what we're talking about here is a first-time home buyer taking up a larger share of that smaller pie. So in order to get it or make it intuitive, think about that repeat buyer actually pulling back. They're the ones that are locked in, right, to the low interest rate. And yet a first-time home buyer, in addition to, say, fundamental reasons for moving forward, like getting married and having kids, or that there's just so many millennials out there, they're also incentivized forward because of higher rates.
Yeah, I bought my first home in 2005. I did not want to buy it. I was worried the housing market was going to collapse. I was right, but I was just early. But we kept getting booted out of rentals because the owners wanted to sell to take advantage of it. We had a new baby, and my wife was basically like, it's the house or me. So I went ahead and we scraped together every dime we didn't have to buy the house that we are still in, by the way, today. Is this almost, I hate to use this term, but I would say I was a desperation buyer. I had nowhere to go.
Well, I mean, you know, what you're actually painting right now is a very real challenge of a household just seeking to make, you know, that normal lifestyle move, right? In order to settle down and stay in one home for an extended period of time. So how do you make it work? That same Zillow survey showed that first-time buyers cobble together down payment sources from at least two places. Some of that is hard-won savings, right? That regular tough challenge. The other part is, say, a gift from family or friends to make it work, or down payment assistance programs.
Yeah. By the way, never say settle down. Just because you move to the burg, you don't have to settle down. I never liked that term. But that aside, I think you nailed it. Skylar, ahead of this, I reached out to a real estate friend of mine. Here's what they said. About 30% of all transactions are all cash. All cash. They don't care about interest rates. And you know what that tells me? These are, a lot of the buyers are the sons of baby boomers, right? My parents are in the generation above that. The baby boomers, a lot of them have gotten really rich off the stock market the last 30 years. How much of this is, do you think, they're not going to the bank of whatever, they're going to the bank of mom and dad to get the loan?
Yeah, I mean, absolutely. You know, about half of first-time home buyers do seek out that bank or mom and dad. That's up from around, actually, I think the number is around 40% have the bank and mom and dad, and that's up from only a third, say, pre-pandemic. But when you think about that picture too, yes, repeat buyers are pulling back, but those that are moving forward are likely to be those downsizers that are liquidating, honestly, records amount of home equity into their next purchase. That is the advantage that repeat buyers who are moving forward have over the first-time home buyer. Yeah. And then if you think about who has access to the bank of mom and dad, that's a pretty privileged network. For other households, they might have to seek out for that last mile, say a down payment assistance program. The rising popularity and actually availability of those kinds of funds is a reason why Zillow now puts information about that on every one of our home listings.
I think, Skylar, you don't have to take the advice. Your next report should be titled, "Okay, Boomer, I need a loan."
Absolutely. One of my slides I call, "This is not the avocado toast," right? Whenever we're thinking about, you know, how long does it take to save up for that down payment? 10% down, saving 5% of your income, you're looking at 10 years, or excuse me, 9 years. Think about when the boomers were doing that back in the 1990s, just 5.5, right?
That's it. Not and by the way, they had a bull,
harder thing to do.
They had a bull market run that just never stopped in the stock market. Just good timing, right? Skylar Olson, thank you very much. Appreciate it.
Alrighty, so yeah, I don't know that kids are doing as well as they were in the past. Comment if you got a down payment from your parents. I mean, how common is that? You know what I mean? I mean, is that really that common? It's not for me. I'm not that lucky, but take a look at this, guys. This is the personal savings rate, just to see how the consumer is doing. And right now we're sitting at a low 4.3%. So basically, in other words, you guys, we have one of the lowest errors of personal savings rate in history. And to me, this demonstrates a few things. It demonstrates how expensive things really are for the common person. And to me, it also demonstrates that people aren't as financially savvy as they used to be. And that, quite frankly, you guys, is a shame. That may be a result of the overwhelming amount of lockdowns that we were in. And people got used to like free and cheap money. I don't know, but I think we can all agree that this should be up. The older that we get, generally, the smarter that we should get with our finances. So we don't really see that there, you guys. 4.3% is nothing. It's basically, again, people can't save their money. That's what that says. And that's not calculating excess savings. Remember that. That's not excess savings. That is something else. So what I'm going to do now, you guys, is we're going to go in, we're going to listen to one more video, and then we're going to do our market analysis at the end of this. We'll do some Q&As. I start some of the comments. I appreciate you guys commenting. But this is our last video right now. I'm going to queue it up real quick. Let me put our timestamp on this bad boy right here. And this is going to go into new home builders and basically what's going on with new home builders right now, okay? Hope you guys enjoy.
Yesterday, Stephen, where you had supply ticking up, days on market ticking up, and now you got told with this average order price miss. Are we seeing some inflection here in the trends?
No, you're not. Certainly not in the trends that can reflect what had been going on through July. I think Diana put her finger on it. You have mixed issues that are going on in an environment where rates have been elevated. The builders are doing what you would expect them to do, which is adjust what they build to make sure that they're achieving affordability. In the case of Toll Brothers, you have some geographic mix going on that I think the CEO did a good job explaining just about 30 minutes ago on their conference call. So you really shouldn't read into that. The bottom line is that all of their forecasts for all the relevant metrics, whether it be revenues or closings or orders or gross margins, they're all going higher. So estimates are going higher for Toll. That's why the stock's up. This is very much consistent with what we've seen for pretty much all the builders over the last few months. But what's going to be interesting, I think, going forward here, because it's all about, stocks are all about what's going to happen, not so much what did happen, is what's going to happen now that mortgage rates have hit a level higher than they were even in the fourth quarter of last year. And so I think the stocks would be up a lot more today if it weren't for concerns that the mortgage rate could maybe change things in August and September.
Right. Explain some of those geographic changes that Toll was laying out.
Well, for Toll specifically, you have to remember that they're a high-end builder, right? Their average price is about double any other builder, right? So they're basically catering to the luxury end of the market. And what they've been doing over the course of the last several years is moving into some geographies and offering some product lines, product types that cater to a buyer with maybe a little lower ASP in mind. And so they've been deliberately making a mix shift, and that has taken them into some markets like away from the coast, for example, which will naturally bring a lower ASP. So it really doesn't demonstrate a weakening or anything like that of trends, as much as it just reflects a little bit of movement in terms of where they're selling. That's all.
Dan, I'll let you jump in here.
I'd be interested, Stephen, to know when we talk about these incentives. The builders had been doing a lot of incentives last fall and into the winter to get buyers back. But then in the spring, they said they really didn't need to do incentives anymore because there was just so much demand. In the past month, though, on the Builder Sentiment Survey, we are seeing builders talk about incentives again, buying down those mortgage rates. That hits their bottom lines. How much can they do on these incentives?
Exactly.
And how long can they do it for?
Yeah, that's a really good point. And so I do definitely think that you will see rate buy down activity increase, particularly for builders that are catering to a more affordably minded buyer. There are limitations. There's a limit on how much a home seller can gift to a buyer and still qualify for various mortgage products. For example, an FHA mortgage, you can gift them about 6% of the loan value, for example. That's your limit, and things like that. So there are limitations.
Okay, I'm so sorry. Real quick, guys. It's the mortgage loan officer in me. I have to correct him real quick. It's not called a gift. It's called seller's concessions. You're allowed 6% seller's concessions for FHA. You're allowed 3% seller's concessions for conventional. You're allowed 4% maximum seller's concessions for VA. When it comes to a gift, there are way less restrictions. And he's saying gift, not seller concession. So just wanted to clear that up.
There. But I do believe that you're going to see the builders increase their activity there if rates stay here or move higher, and that will put some pressure on their gross margins. And I think that most investors, should be pretty clear-eyed about that. On the other hand, we are still seeing that there is still ample demand for the product that they are selling, and so the outlook for 2024 and the earnings per share, we think are still going to be moving higher as we go into next year. Remember also that most of these public builders, including Toll, have done a wonderful job shoring up their balance sheets. So you saw Toll, for example, get more aggressive with their share repurchase activity. And I think that that's something that you can also look forward to as you head into next year.
Stephen, just to follow up on your kind of outlook for 2024, what happens to this whole dynamic if we do start to see a cut in rates?
Well, a cut in rates. So a reduction in mortgage rates is just good for home building demand. It increases affordability, and it makes all kinds of things look better. It basically gives the ability to raise prices or reduce incentives in the industry, because it doesn't actually do anything to increase the supply instantaneously, right? So it increases the demand. The supply is the same, and that has a very positive effect on your price, and that means better margin. So lower rates as we head into next year would be nothing but good for the builders. There is a false narrative out there that perhaps if rates go down, that you're going to see a whole bunch of people put their house on the market. That might increase inventory, and that's bad for. Don't believe any of that. That's not true. That you might see more people decide to move, but that means you're also going to see more people look to buy, because a mover is a buyer and a seller. Their impact on the inventory isn't particularly significant. But I would say that lower rates, no question, better for builders next year.
I guess it depends on whether they buy or rent where they're going. I guess that's a dynamic we'll have to see flesh itself out. Diana, Stephen, thanks, guys.
All right, guys, that is going to do it for the video. So we're going to go into now, we're going to go into the market analysis. So we're going to go into the value part of this video. If you don't want to be a part of the value, I understand. That is going to complete our market analysis, but we're going to do our value, and we are going to do our Q&A after the value. Now, I had a viewer ask me to do a market analysis on a subdivision, okay? The subdivision that he gave me, unfortunately, it only had one listing, which was Marlow Lakes. I don't know why it only had one listing. And then when I checked the last 360 days, there was no comp. So I'm not going to do it on the subdivision. If I had more time, Julius, and this is for Julius, I would tell you why that was. So instead, you guys, unfortunately, and I'm not recommending this is how you do it, but I'm going to go based off of zip code. And that's not about zip code. Remember, it's about subdivision, but I'm going to go off of zip code. And here's basically what we're going to fill out right here. You guys are familiar with this. Now, what I have done is basically for Julius, this is going to be our market analysis form. We're going to try to figure out cash flow. We're going to try to figure out wedge. You can see here I'm using a zip code. Okay, I'm not using a subdivision. That's bad. You don't want to do that, all right? And also I pointed out this. Take a look. Julius is only paying $1,200 in rent. Okay, so more than likely, he's going to be paying a lot more than that when he buys a house. If he's only paying $1,200 and his price point is $250,000. Julius, if you're there, if you're watching, Julius, let me know your down payment. And if you guys see Julius and I don't see him, please let me know what his down payment is. The reason I need to know his down payment is because I got to calculate his payment in order to figure out cash flow. Now, he's being quoted an extremely low interest rate at 5.8%. He also confirmed in the 5.8%. First of all, I was like, how are you getting a 5.8%? And he confirmed that his total closing cost is $16,000. If the loan amount is $250,000, obviously that's what, 5 or 6 points to close, which is a lot. So he's probably paying 2-3 points to get that rate down to 5.8. I'm not 100% sure, but again, Julius, if you're there, please let me know your down payment so I can properly calculate this. But again, here, once again, this is my template. You guys can copy it. Please copy it. This is all we really need to get a general idea. And what I am also going to do is I'm going to hop into this camera and I'm going to pull up my matrix. All right. Okay, so we're going to do it right now. We're going to look at zip code 77591. And you guys are familiar with this, especially if you're a realtor. This is the point of being a realtor. This allows us to basically analyze sold property. Okay, this is so important, you guys. This beats out Zillow, CoreLogic, any of the lagging data. This is how realtors can be so on top of the housing market specific to their area, because of constant fresh data. We can run so many different reports. So let's do first, let's put the zip code. Okay, so we're going to put the zip code down. Where's my zip code? Right here. Okay, so 77591 is the zip code right here that we're going to do a market analysis. Now, first of all, again, remember, you guys, I want to see sold properties for the last year. That's how I'm going to do this market analysis. Okay, so I'm looking at sold properties for the last year in 77591. Let's look at the results. There was a total of 200. Okay, so his down payment's $25,000. Okay, let me put that real quick. 25K is your down payment. Okay, that's actually, I can't write on my iPad with this. What am I doing? Oh my gosh, I just wrote on my iPad. You're messing me up, brother. All right, so he's gonna do 25K down. All right, let me write that real quick. Now, here's our info. So we have 258 total homes sold. All right, you can see the 258 right here. And again, you guys, the reason I don't like doing zip codes when we're getting this close to purchasing is look at all the different subdivisions. If we don't want other subdivisions in this report, but we have no choice for the sake of this video, understand what I'm saying, okay? So we're gonna act like that's not an issue, but I'm telling you right now it's an issue, but we're gonna act like it's not. The next thing I do, you guys, is I wanna select all of this data. And the cool thing about Matrix is it will categorize median and average. If I go to stats and hit tabular down here, okay? So now that I have everything checked, I can see my adjusted average price per square foot and median. I'll just use average instead of median. So it's $144.16. So what I do is I go back here, okay? And I'm gonna put the average price per square foot right here at $144.16, okay? Because now I have that information right here, see? So now I've equipped myself with knowledge. And one of the reasons why I'm doing this is because he was excited when he joined the live and he's like, it's a great deal. And I'm like, did you even do a market analysis? And he's like, no. And I was like, dude, how do you know it's a great deal if you don't have the data, right? So now we're gonna go back, okay? And we're gonna go to now the rental matrix, see right here, rental matrix, and we're gonna calculate the average rent, okay? And we're gonna go through all sold for the last 1 year. So I'll change this to 360 days. And I'm gonna put the zip code right here. Again, instead of the subdivision, 77591, okay? And it's gonna give me 102 rentals. So I have 102 rentals now. Let me hit results. You guys see that? Look at 100, that's kind of crazy for a zip code, only 102 rentals, okay? So again, I'm gonna do the same thing as I did before. I'm gonna select all of the data. I'm gonna hit stats and tabular. And I'm gonna get my price per square foot as far as rental. This is actually pretty good. It's actually, I'm surprised it's that high. Now, again, you guys, there's probably gonna be outliers here, okay? So I'm telling you now, this is not the proper way to do it, but for the sake of argument. So we know so we know $1.13 a square foot. Okay, so I'm gonna go back here and I'm gonna put $1.13, okay? With that data alone, I've just empowered myself with an ability to make decisions pretty much independently. Again, so long as I have the data, I can make up my own mind, all right? Now that we have that, we're gonna go back into the matrix, okay? Okay, and we're gonna look at the active listings now. So I'm gonna go back here. We're gonna put in our zip code. Julius, you better be watching this, Julius. This is for you, brother. All right, I want you to know that. This is for you. You better be watching right now. Because I was gonna do something entirely different, but I saw your comments and I'm changing my entire life for you, man. So here's our location. Again, I would normally put subdivision, but I'm only doing this. Okay, so I wanna look at, why is it not coming up active? Okay, let me actually refresh this. Sometimes that happens in the matrix. It doesn't pull up automatically. So again, I'm gonna go active. I wanna put, oh, okay. I'm gonna put my zip code. What is my zip code again? 77591. Okay, sorry about that. All right, so we have 82 listings, brother. So here's all of our listings, okay? These are all of, and it's only 82. It's actually small zip code. So this may be okay. Now, remember what I taught you guys. We want to be careful for outliers as well. But I'm going to first categorize this by price per square foot. Now, remember what the average is? The average is $144.16. So essentially on the first page, all of these homes up until comp number 22 right here is selling for under the 1 year average. Do you hear me? So 22 homes are selling with some type of wedge. Okay, you guys follow me? You guys see that? Because again, look at, I'm looking here, price per square foot. See that? And look at this, you guys. Some of these houses, and see, if I wanted to spend more time on this, I would like, why is this house selling for $60 a square foot? Why is this selling for $67 a square foot? Y'all see what I'm saying here? So those may be houses that we investigate with wedge, but I'm not going to waste my time doing that. He said, oh, look at, here's Morrow Lakes right here. Okay, so here's Morrow Lakes right here. Boom. So I'm just going to use this house right here as an example. All right, so let's do a market analysis on this property. All right. You're lucky, Julius. So this property is in Morrow Lakes where he wanted to look. It is in his price point of $250,000. And I do want to point out, you guys, there was a recent price cut about 1 week ago for $60,000 off of this existing home. So this existing home has $60,000 off, all right? But now what we need, and also look at this, you guys. So it is being sold for under market value. You see that? Because we know that normally, again, this we're talking about zip code, not talking about subdivision. So Julius, I want your realtor to do more research for you, okay? But nevertheless, based on the data we have, this is being sold for under market value. All right, so the next thing we do, we come back here and we start filling a little bit out, okay, starting with the price. So the price of the property is $250,000. The square footage of the house was 1,955 square feet. Let's look at the taxes. Tax rate's 3. Oh my gosh, the taxes are, this is bad, Julius. You guys, the taxes on this property, you ready for this? $9,000, oh my God, $192. That's how much the yearly taxes are on this house. Oh my gosh, dude. Okay, so the tax rate, I'm sorry, the tax rate is actually 3.29%. That is brutal, Julius. That's brutal, dude. All right, so now what we're gonna do, okay, staying on this form, we're gonna calculate the market value and we're gonna calculate the market rent. So the first thing I'm going to do to calculate the market value is I'm going to multiply the average price per square foot, okay, times the square footage. So these two things right here will allow us to calculate market value, okay? So I'm going to go $144.16 a square foot times 1955 equals a market value. Okay, you ready? You ready, Julius? Market value. Why isn't his realtor doing this, you guys? Why isn't Julius's realtor doing this? Okay, so the market value is $281,000. Now the purchase price down here is $250,000. So what we do to find wedge is we subtract the $250,000 from the $281,000, and then we get, this is what we get for wedge. Okay, you ready, Julius? Again, we need the subdivision, but this is what we get for wedge. $31,832. And you guys remember how I got that? I took the market value here and subtracted the purchase price. So far what we know is this house possibly has $31,000 in wedge. Okay, but now what I want to do is I want to calculate the average rent. So what I do is I take the average rent here, again, multiply that by the square footage. So I'll go 1955 times 1.13. Okay, that equals a market rent of $2,209. Now what we have to do is we have to calculate this payment, okay? We're doing a lot, but you guys can always come back here and reference this. Now remember, in order to calculate payment, I'm gonna come over here. I'm going to throw this up on the screen just so you guys know I'm not quoting anything here. I'm just using public information to help you guys. Okay, this is not something that I would do if I was going to buy a house right now. I would do a lot more specific research, but we're just using general info. Here's our mortgage calculator. I'm going to hit add taxes and insurance. Okay, he said the home price is $250,000, and he said he's got $25,000 down. Right, so that's 10%. And he also said that he has an interest rate quote, even though I don't think this is going to be accurate. That's okay. Let's just say he said 5.8. Okay. So I'm calculating that. See how easy this is to calculate? Now, here's the one that hurts, Julius. This one's going to kill you, dude. This one's bad right here. So we got to put the taxes yearly of $9,192. Remember, we just got that. You see how all of this is intertwined, you guys? You see how empowered you can be if you really put this to practice? Now, home insurance I'm going to raise because it's going to be higher. Okay, and that's it. Now, what is our payment? Okay, so this means, based on what he said, his estimated payment is going to be $2,903. So we go back here. What do we put as the payment? And Julius, tell me if you got an estimated payment already and tell me how close my payment is to your estimated payment. And I'm going to be honest with you, man, as a loan officer, very few people can keep up with me as far as my accuracy with these numbers. So I'm pretty sure my numbers are going to be closer. I'm a little bit cocky there. I get that. But let me show you guys one other unfortunate thing. Okay, so we're going to go back into this and calculate cash flow. Okay, so remember the market rent is right here. His payment is right here. So that means, is he going to have cash flow, you guys? Do y'all know if he's going to have cash flow or not? By just glancing at these numbers, you should know that he is not going to have cash flow on this property the way it's set up. Okay, do you see that? So he's going to have negative cash flow. So in the property that we looked at, based on the zip code, he will have negative cash flow. However, he will have approximately, what, 12% in wedge. Okay, so if it's me, okay, Julius, and I'm you, and I want to get cash flow, some of the things that I may be able to do to get my mortgage payment down, let me show you actually. I'm going to pull that up right here, okay? Let me show you some of the things that I would do to lower my mortgage payment, okay? Because remember, you guys, I'm paying the PMI up front. So for me, it's a tax deduction, and it will lower my mortgage payment. It'll cost me maybe $3,000 to $4,000 extra in closing, but let's see what the payment goes down to. So one way, and you guys starting to see why I pay the PMI up front. So one way to get this man cash flow, barely any cash flow, $19 cash flow, is for him to pay off the PMI up front. All in all, you guys, I'm going to be honest with you. I don't like it. I don't like it. I like the wedge, but there's two things that matter, the wedge and the cash flow. So overall, Julius, I got to say, man, I don't like it. I don't think we have enough data. If there's more comparable data in that subdivision that says that, you know, homes rent for more, or that the homes are being sold at a higher price per square foot, I might be interested. But again, man, there's just too much going on in Houston right now for me to jump into the existing home like that, especially when we take into account, again, this is just if I was you, I'm not giving you any advice, but when we take into account the insane deals right now around Houston for new construction, and I'm not talking about just Lennar, I'm talking about multiple home builders, there's no way I'm buying that house. I'm just being real with you, man. But, you know, I hope that helped, man. Not trying to like pick on you or anything, but I hope that was extremely helpful. I'm going to go into the Q&As real quick now, guys. Julius, if you can, man, comment and let me know that everything made sense. I don't see you. So just comment, man. Oh, there you are. I see you. Okay. So that was my honest breakdown right there, brother. I'm trying to be honest with you. But his realtor said it was a great deal. And that's why I would do that comparison. Let me throw up some comments, you guys. I got the first comment from my man, Don't Move to Texas. Dow will drop 400 points as soon as the speech is over. Then by the end of the next day, it will be up 150 points. It happens every minute speech for the last 6. And probably the reason this is, you guys, is because the market keeps wanting to fight the Fed. They keep underestimating how high for how long, even though, again, they're telling us. So I honestly, that's exactly kind of what I suspect. I suspect Jerome Powell tomorrow is going to get up there and he's going to try to be dovish, even though his actions are hawkish, right? So this is from Elena. Yo, Trav, PA is cracking. I can't believe it, but it's true. During the summer, there weren't anything under 600K in Philly Metro, but today, same houses are 550 to 565. So, you know, the reason I'm pulling this up, you guys, is because there's so many different metro areas in so many different states. And this is intel in the Pennsylvania area, where at least in her area, that, what is that, 10%, almost a 10% price decline. So kind of good, right? The more info we get, the better. This is from Deuster. Deuster, love you, brother. Hope everything is okay. Hopefully you're loving your new house. That's the key. Lots of savings from COVID. 2 to 3 years of savings needs to be dissolved first. And you guys, I'll be honest, that was one thing that I didn't see coming. That was, you know, one thing that I've been wrong about this year is how much reckless obsession there's been with home buying. I didn't see that coming. I equate that basically to two things that I underestimated. The first thing I underestimated was the excess savings. I didn't realize how much excess savings there were, and I didn't realize that people would just throw that away, because I'm not throwing it away, right? And then the bank bailout, I did not see the bank bailout coming. I thought, honestly, the bank bailouts were going to lead us right into recession and a continuation of price cuts. But the thing is, Deuster is right. There still is excess savings. Again, there's a brand new report that just came out that's saying instead of most of excess savings being spent by the end of this year, it's going to be up in October. How the heck is it going to be up in October when school loans start? Interesting. Let's do this next comment. Thank you for commenting, guys. I appreciate your comments. I'm not sure if RJ shows the data like that, or even Reventure. All of these services are paid, not all, but a lot. I was hoping Fred Oh, I remember. So they were asking for median household income as it pertains to mortgages. Okay. And I put that comment up because let me just show you. Okay. Black Knight. So if you guys want to kind of see what he was talking about, which is like household income, there is, you guys, I hope you're going to Black Knight. If you guys go to Black Knight, hit data reports up here, and we're going to go to origination market monitor. Okay, can you see that? Oh, let me take this comment off. Okay, so we're going to go to this, check this out. So this is going to give you stats like that. I love looking at this stuff. I don't reference it a lot because I think you guys would be bored because I'm like a nerd with this stuff. But here it is right here. If you guys really want to like jump into like what are like how are people qualifying for mortgages right now? Let me see if, but again, this is free. So they changed the information here. But nationally, let me see nationally. Boom, boom, boom. So it's not going into the income, but nationally, average purchase LTV. Wow, that went down to 80. It's 88%. So 12% down payment. That's crazy. So it's 12% down payment. Average credit score, dang. Okay, so average credit score 730. Average interest rate 6.77. That's insane. So, and this is like lock volume. Who cares about lock volume? We don't really need that right now. Here's a market rate in indicators. This is just going into the various types of loans and how the interest rates are different depending on the types of loans. Here's the spread for the 10-year. Let me see if we have income. But this is where I would look. Oh, look at the rate and term versus cash out refinance. Cash out refinance right now, you guys, is accounting for almost about 90% of refinances are cash out refinances. So people are doing something similar that was happening during 2008, which is using their homes as an ATM machine. That's going on right now. Okay, and if you guys want to go into here, this is the different types of loans. Most people are getting conforming or conventional mortgages, which is good. I also want to point out this. This is crazy. So not only is this like huge like increase in cash out refinances per se, the FICO score has plummeted. And to me, this is demonstrating two things: that there's not enough credit tightening in cash out refinance, and also these are people that are struggling, because it is their credit score is way lower, you guys. 690. You see that? Cash out refinance 690 as opposed to purchase and rate and term in the 700s. This is showing us consumers, homeowners specifically, are suffering. That's what that's showing you guys. Let me see if I can get you guys anything else. Here's the credit scores right here again. 669. That's crazy. So see how FHA, dang, that's crazy, you guys. That went under 660 in January of this year. I didn't realize that. So FHA is a lot looser of a loan. It's a lot easier for people to qualify for FHA. But anyways, it doesn't look like this one's going to have the income, man. I'm sorry about that. But I would go to places, like that. Also, FHFA has good stuff as well. If you go to FHFA, they have really cool reports. Sorry, I was hoping I could find that for you. Sorry, man. Next comment, you guys, from RB. I want to buy a house so bad. RB, join the club. And if you want me to give you empathy, suck it up. Patience is a virtue, okay? Us being patient is a strength, not a weakness, okay? Because of the type of patience that we have, which is we're improving our situation. Also, here's a comment. And real quick, I wanted to just throw some love out your way, Tony. Dude, I see you on the comment section sometimes, man. I love you. I appreciate you being there, Tony, from the beginning. And I appreciate your comments. Even if we don't agree all the time, man, you give refreshing insights. And sir, you should be, I'm proud of you for that. So thank you for all the support, you brother. I wanted to bring this up specifically to say that. But also, if the Fed were to cut in May, prices will suffer due to credit contraction. Nobody wants to lend during a recession. So I wanted to talk about that because it's exactly right. If we cut rates right now, we're doomed. We don't want rates to be cut until a couple things happen. Recession, i.e. unhinged unemployment, and even more credit tightening. We can have rates lower if the credit tightening is stronger, right? Because if the credit tightening is stronger, that's an additional factor that will dampen demand. So there's multiple things going on right now, obviously, outside of just supply and demand. Supply and demand would work if everything was consistent, which it's not. Jeff got jokes today. So he's basically saying use cheaper materials to get cheaper homes. And he's also saying, yeah, right. Because we all know that the profit margin in these homes is like out of control. So this is a comment from Christina Clark. I think that the powers that be want to keep the narrative that all is well. I know people that believe this, but the reality says otherwise. And I really wanted to bring this comment up because Christina is exactly right, you guys. If we look back at Ben Bernanke, and keep in mind, he got awards for how great he was, but yet I got failed. I listened to him. I had a foreclosure. I'm going to tell you guys, okay, probably this is arguably one of the most important jobs of the chairman of the Federal Reserve is to keep us calm. The second that consumers freak out, usually things get unhinged. So in other words, what I'm saying is we know he's lying to us. We know that. We shouldn't be surprised. We know his job is to keep us calm. That's why I think he's going to go out Friday, Christina, and he's going to try to keep the markets calm, like everything's okay, we're winning this battle, la da 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 da, so that he can keep hurting us. I hope that's what he's doing, right? He wants to, as long as we keep this going, it's going to continue to cripple us. But again, if they cut rates too soon, it's just, it feels like all for nothing. This is WTH, appreciate you, brother. The fact that there is an upcoming election and there is this major effort to muddle all. I'm scared of the election, you guys. I do believe that during elections that there's data manipulated. I know that. And also, you guys, I do want to point out that Redfin still hasn't, they sent out their market updates today, but it's missing all of the data. So, I find it very suspicious that right when we needed the data, okay, right when the data was showing price decline, it's no longer available. Anyways, I don't like it. Also, regarding Buffett, because everyone's like, oh, Buffett, like y'all don't know what. Here's the thing, you guys, I'm not talking about Buffett because I understand I don't know enough about stocks, but just to let you guys know, Buffett reported he purchased stocks the other week. I believe that was in Q2. We don't even know if he still has it. And then what if he anticipates a total collapse in the market? Maybe he could take over D.R. Horton. Who knows what he's doing, but I'm not going to act like I understand what's going on through that mind. And then let me ask you guys, didn't he lose a whole bunch of money with Bank of America just recently? Just saying. All right, so this is a comment. New studies say mom and dad are giving average of around $1,700 a month to their children. We have a worse spending habit right now than we've ever had in the history of the United States. I mean, holy, you guys getting any money from your parents? I'm not getting any money from my parents. Okay, this goes into Berkshire Hathaway again, purchased home construction companies in the second quarter of this year. D.R. Horton was trading at 98, tapped out at 131, and now it's retreating back to 118 because a lot of people are like, oh, Warren Buffett, whatever. You guys don't even know. We don't know what he's holding, or I don't. Another one, this is good. The millennials who got money from their parents are making bad choices. No one is paying attention to the actual price. Just if they can afford the mortgage, that's a huge problem, you guys. That is a huge problem. I can't tell you that we need to be looking for a great deal with Wedge and with cash flow. Let's pull up another comment here. Are there more reasons to the increase in incentives for new constructions to make the buy more attractive, builders using cheaper materials? So there are reasons for an increase in incentives, and that reason is they must sell their houses. Remember, you guys, despite all of these headlines, they're doing great, their stocks, Warren Buffett. Remember, this will never change. What I'm about to tell you will never change. They must sell. There's always going to be forced selling with new home builders. The thing is what are the conditions of the market that matter, right? What are the conditions of the market? So I'm going to tell you, the reason why they're doing it is because this is the only way they can sell their houses because of the massive run-up in equity and the massive out of control and affordability. They can't sell their houses any other way, and we see that. And not only do we see that, we see it stop. Basically, it stopped working as well, right? And think about it. We went from temporary buy downs to now permanent buy downs. It's not working anymore, you guys. All right, you guys, that is it. I am going to get out of here. Oh my gosh, I forgot to put the timestamp in the Q&A, so that's okay. But I got to get to the office real quick. I really appreciate you guys. We're going to try to do a live tomorrow. Check out Jerome Powell. I hope each and every one of you got value. I hope you guys are more equipped homeowners. Don't forget to like this video, you guys. Don't forget to comment and share videos. I appreciate you again. And if you're out there investing in real estate, you already know I wish you luck, and I hope you win. Thank you guys again.